The government has signed loan facilities worth rupees 1.225 trillion with 18 banks to clear dues of independent power producers, a move that will settle electricity consumers with a rupees 3.23 per unit surcharge for the next 6 years. The signing ceremony took place at the Prime Minister's office on Wednesday, with Prime Minister Shehbaz Sharif witnessing the deal virtually from New York. No official announcement was made, but ministers confirmed the agreement. Under its terms, the government will have 30 days to request reimbursements from banks, which must be promptly used or allowed to lapse, and 3 months to draw down approved funds. The loans will be serviced through a debt service surcharge extended for another 6 years beyond its current expiry in June 25. Of the rupees 1.225 trillion, about rupees 659 billion will go towards loans payable by Power Holding Limited, while the rest will settle IPP's arrears, petroleum sector dues, and subsidy arrangements. The arrangement will cost the government an estimated rupees 640 billion in interest, with quarterly repayments of rupees 310 to 315 billion expected from consumer surcharges. The Ministry of Finance, working with the State Bank of Pakistan, finalized the agreements with a consortium of banks including Habib Bank, National Bank, United Bank, MCB, Mizan Bank, Bank Al Falah, and others. The loans carry an interest rate of Kibor minus 9% over 6 years. The DSS extension required amendments to Section 31(8) of the NAPRA Act, made part of the Finance Bill 2025-26. This also removed the previous cap limiting surcharges to 10% of the base tariff. Pakistan's circular debt, which stood at rupees 1.661 trillion by end July 2025, remains one of the country's most severe fiscal challenges. Despite bringing it down to rupees 2.393 trillion in June through subsidies worth rupees 780 billion, July alone saw a fresh build-up of rupees 47 billion. Economic observers have repeatedly warned that without reforms to address theft, poor recoveries, and inefficiencies, fresh borrowing will only worsen the crisis. The Institute of International Finance recently noted that energy sector debt amounts to nearly 4% of GDP, weighing down growth, inflation, external balance in the financial system. It warned that circular debt and energy subsidies continue to divert resources away from social programs, infrastructure, and private investment, crowding out the economy while deepening fiscal imbalances. For more on this, read the Dawn story linked below.